When this signal does not appear on your chart, do not take any trade. The signal I am referring to here is called the first pullback, and in this video, I will explain how you can use it to reduce your losses and book higher profits in every trade. So without any delay, let's begin. What is the first pullback? It is a highly predictable pattern that appears in almost every trade setup. How does it work? Let's understand. Assume that the price was in a downtrend and now it has reversed and started moving into an uptrend. As we know, whenever a trend changes, a perfect V-shaped reversal is very rare. Usually, price first reverses, then forms a small pullback, and only after that continues to move higher. This initial pullback, which appears for the first time after the reversal, is what we call the first pullback. And I am not exaggerating when I say that this pattern appears on every chart. If you need proof, let's look at some examples. Look at this 4-hour Bitcoin chart. Price was first in a downtrend, then it reversed and started moving upward. But before the move continued, a small pullback formed, and then the price shifted into a higher trend. Now look at another chart. This one is of gold. This time, price was initially in an uptrend, then it reversed and began falling. But before continuing downward, it formed a small pullback. Here is the chart of Tata stock. Price was previously in a downward trend, then it reversed, created a pullback, and after that moved upward again. You can see thousands of such examples on any chart. After watching this video, try it yourself. The main concept behind this strategy is to watch the first pullback and enter at the end of that pullback. Its biggest advantage is the risk-to-reward ratio. Let's understand this with an example. Assume that the price was in a downtrend. Then, suddenly strong buying pressure appeared, and the price started moving up. As a trend trader, you may notice the trend shifting and think about entering a buy. However, buying immediately at the trend high is not the right decision. Why? Because the price can pull back, or even worse, the trend could completely fail. If you enter at the high with a tight stop loss, even the pullback can stop you out. And if you place a wider stop loss, then in case of trend failure, your loss could become very large. This is the reason why waiting for the first pullback and then entering is often a better strategy. Entering on the pullback gives you a better price, which allows you to keep a smaller stop loss. If price continues to fall after the pullback, it signals that the trend is now invalid. In that case, a tight stop loss will help reduce your loss. But if the trend holds and price moves upward, entering at the lower price can help you earn higher profit. It's a win-win situation. If the trade fails, the loss is small. If the trade succeeds, the profit is high. Now let's break down this strategy step by step. The first step to trading the strategy is understanding how to identify a trend reversal. Let's understand this with an example. Assume that a chart is making higher highs and lower lows, which clearly shows that the market is in an uptrend. But then something different happens. Price starts falling and breaks a previous low. This is where most traders make a mistake. When price breaks this low, many assume that the trend has reversed and the market is now in a downtrend. But what if I tell you that this chart is still fundamentally bullish? Yes, price broke a low, but that low was not actually valid. Why? Because it did not break the valid low, which is this one. To make it even clearer, a low is considered valid only when price breaks the previous high after forming that low. In our example, price never broke the previous high, which means that this is the valid low. So as long as price remains above this valid low, it will still be considered an uptrend. Let's take it one level further. If price moves upward and breaks the previous high, it establishes a new high. In this case, the valid low shifts to the most recent low before the breakout. And to reverse the trend, price must now break this new valid low. Now let's see this on a real chart. Here, price is flaunting higher highs and lower lows, and we confirm the identification. Remember, to confirm a reversal, it is essential that price closes below the valid low. Once you learn how to spot a valid reversal, we can move to the next step, entering on the first pullback. When entering on the first pullback, it is important to understand where the pullback may take place. This is crucial because a pullback can form at any area of the chart, and identifying the correct zone is very important for entry timing. From my experience, there is a specific area where the first pullback has the highest probability of forming and bouncing. These are called supply and demand zones. If you are not familiar with supply and demand zones, they are areas where major buyers or sellers executed significant trades. Or you can watch my video on supply and demand. The simple concept is, if price retraces to a supply or demand level, there is a high chance of bouncing from there, similar to how support and resistance work. So if we correctly identify these zones on the chart, we can figure out where the first pullback might occur. The easiest way to identify supply and demand zones is to look at areas from which price made a strong move. For example, if price suddenly moves upward, the area just before that move is called the demand level. Similarly, if price suddenly falls, the area before that drop is called the supply level.
Now let's return to our previous example. Here you can see that price formed an impulsive downward move. To mark the supply zone, highlight the last candle before the impulsive move started, this one. Now use the rectangle tool to draw a zone from the high to the low of that candle. This becomes your supply zone. Once the supply zone is identified, you can set your entry a little below this zone, your stop loss slightly above it, and your take profit at the previous low. Now let's make one thing clear. In this strategy, you are not entering at the current price, but instead placing a limit order at your desired entry price. Along with this, you also define your stop loss and take profit levels. Once everything is set, you do not have to do anything, just allow the price to do its work. The trade will only activate when the first pullback forms and price reaches your entry point. In this example, price retraced, touched our sell entry, and bounced from the supply level, giving us a good profit. But remember, there will be times when you place an order but price moves forward without triggering your entry. This is completely normal because the trade never activated, so you will not incur any loss. The biggest advantage of this strategy is that only those trades get activated which align perfectly with our trading plan. If a setup does not fit properly, do not try to force it. Be patient and wait for the next opportunity. Let's look at another example. Again, the first step is to spot the trend reversal. In this setup, we can see that price was in a downtrend and then started moving upward. But observe carefully. In this particular move, price did not give us clear lower highs or lower lows because the drop occurred in a single swing. So in situations where there are no clear highs or lows, how do we determine whether this upward move is truly a reversal or not? This is where trend indicators come in. There are many options available in the market, but I prefer MACD because it is simple and reliable. Once MACD is applied to the setup, we can use it to confirm whether this upward movement is a valid reversal or not. In this setup, we see MACD crossing upward here. That is our signal that the reversal is valid, and we are now in an uptrend. Now we can move to the next step, which is entering on the first pullback. For that, we follow the demand zone identification. In this example, price pulls back, triggers our buy entry, and then continues upward to hit our take profit. Even though this trade was successful, you will notice that price experienced a small drawdown and came quite close to our stop loss. However, because we stuck to our initial plan and allowed the trade to play out, the price eventually hit take profit. This is why it is so important to remain committed to your initial trading plan. Even with slight drawdown, trusting your analysis and allowing the trade to play out can lead to a winning trade. Now, an important question arises. What if supply and demand levels are not clearly visible on the chart? There is another method I use to find entries on pullbacks without looking at supply and demand levels, and that is the Fibonacci retracement zone. Basically, this tool automatically highlights key levels based on Fibonacci numbers. As you can see, this tool generates multiple lines, and price can bounce from any of these levels. But one specific level, the 61.8% level, also known as the golden zone, is the most reliable because price often pulls back there. How to use it? First, if I identify a potential first pullback scenario, I draw the Fibonacci tool from the lows to the highs. Then I place a buy order at the 61.8% level. I set the stop loss slightly below it, and for take profit, either target the previous high or even a higher level, because in such setups, price can run quite far. Once everything is set, just allow the market to play out. As seen here, the price barely wicks to our entry point, then bounces and the trade becomes successful. Now here's the most interesting part. First pullback is not just a stand-alone strategy. It can also be used with your existing trading strategies. For example, a popular strategy is the breakout strategy. I will not go too deep into it here, but the basic idea is that price consolidates in a range for some time, and when it finally breaks out of that range, it makes a sharp, quick move. This gives you very little time to take the entry, and if you chase the breakout and enter late, your risk to reward can become very poor. So what do? I wait for the first pullback to form and then enter. Once the breakout occurs and slight exhaustion appears in the trend, I apply the Fibonacci tool from the lows to the highs, then place a buy order at the 61.8% level, set the stop loss slightly below entry, and keep take profit at the previous high. Then I simply allow the market to play out. As seen here, the price barely wicks to our entry point, then bounces, and the trade becomes successful as well. Now, let me make one thing very clear. Price will not retrace every time, and sometimes it will move directly forward without pulling back. When using this strategy, you will miss some trades. But remember, missing a trade is always better than taking a loss. Personally, I prefer sticking to a high win rate setup instead of entering at a bad price. If you found this video helpful, don't forget to like and subscribe. It takes only 2 seconds, but it greatly supports the channel. Thanks for watching, and I'll see you in the next video.